Okay, chapter 36, extending the analysis of aggregate supply. We are going to look at the transition from short run aggregate supply to long run aggregate supply. Okay, so in the short run, aggregate supply is sloping upward. Okay, this is the overall price level in the economy. This is real GDP. Okay, and aggregate supply is sloping upwards. And we assume that input prices are inflexible. So remember, inputs are what are used to make the output. So if the output is, for example, a cake, then the inputs would be the wages of the workers, and then the supplies like the sugar, the butter, etc. And in the long run, we assume that input prices are fully flexible. Okay. And that long run aggregate supply curve is vertical. So price level changes do not affect output in the long run. Okay. So let's talk about how this transition happens. Okay. So let's look at when production is above potential output. Okay. All right. So the economy is doing well, firms are producing a high level of output, and in order to be able to supply this high level of output, they demand more inputs, and so input prices rise. This increases the cost for firms, and an increase in input costs shift aggregate supply curve back to the left, and so we return to potential output. And then we'll also look at the case when production is below potential output. Okay, so okay. This is aggregate supply 2, aggregate supply 1, and aggregate supply 3. Okay, so let's say, okay, that the firm is producing at this point over here. Okay, so because price level has increased from P1 to P2. Okay, and so what's going to happen is in the short run, okay, production is above potential output, which is QF over here. Okay, and in the short run, input prices are inflexible, especially wages. Okay, well, wages seem to be the most inflexible variable. And so usually the price of the good rises, of the output rises. And what happens is since input prices stay constant for a short period of time, then the firm is making more of a profit because they raise the price of the output that they're selling to consumers, but their costs are staying the same. But eventually, in the long run, their costs are going to rise, okay, because they are demanding more inputs. And so they're going to have to pay their workers more, they're going to hire more workers, they're going to have to pay more for other materials, for example, and if they expand their production plants, again, that's a cost, and supply will shift back to the left. Okay. And so in the long run, okay, they will return back to potential output. All right, let's say price level drops, and so now the firm, since the price of their output has fallen, they don't produce as much of their output, because in order to produce more levels of output, they have to be able to get a higher price in order to recoup the higher input costs. Okay. So in the short run, their input prices remain high because, again, wages don't go down very easy. It's very hard to get workers to agree to a wage cut, or even to just agree to not take a wage increase. Okay, and a lot of their inputs might be under a contract, and so they have to wait for that contract to expire in order for there to be renegotiation of prices. But in the long run, okay, wages are flexible, any other inputs are flexible, the price of them is flexible, and so usually what will happen is input costs will fall. And so at that current price level, aggregate supply will shift to the right. Okay. Okay. So at P3 in the long run, output would be back at its natural rate. Okay. And so if we connect these three dots, okay, we get our long run aggregate supply curve. And so the long run equilibrium price level and equilibrium level of output is determined by the intersection of the long run aggregate supply curve, the short run aggregate supply curve, and aggregate demand. Okay, so let's look at the case when there is demand pull inflation in the economy. So due to an increase in aggregate demand shifts to the right. So we go from 81 to 82. Okay, and so what we see here is that we're at point B, where output is above potential output, okay, and price level has increased, okay. But what's happening though is with a higher price level is that there is an upward pressure on input costs, okay. So eventually wages will have to rise in other inputs. The price of the other inputs will have to rise as well because of the ongoing inflation. And so this will shift aggregate supply to the left. So we go from AS1 to AS2, and we're back at the equilibrium level of output in the long run, and also at a higher price level here. So we went from P1, short run, we were at P2, and we ended up at P3. Okay, in the case of cost push inflation occurs when there's been an increase in the price of one or more resources. So if the price of oil, for example, spikes up, that increases the cost for many firms because they have to transport their goods and services. So the transportation cost, for example, has increased. And this would shift aggregate supply to the left. Anything that increases cost shifts aggregate supply to the left. Okay, so originally we were at point A, and now with aggregate supply shifting to the left, we're at point B. Okay, so two things are possible here. The first one is that the government decides to just let it be, because what's happening right here is that output is below the potential output, and so we have unemployment. The unemployment rate is below the full employment rate. And so if the government doesn't do anything, then because the economy is in a recession, there will be downward pressure on input costs, especially wages. And so the theory is that eventually workers will accept a lower wage and that other prices would fall as well, and the economy will go back to equilibrium because aggregate supply will eventually shift back to the right as wages and other input costs fall. Now let's say we're at point B again, and the government doesn't want to wait for the economy to correct itself because sometimes it can take a very long time. And so they engage in expansionary fiscal policy. And so this shifts aggregate demand to the right. And we end up at point C, back to the full employment level of output and at a higher price level. Okay, because sometimes the economy doesn't necessarily correct itself. Like if we're back at point B and the government decides to be laissez-faire. I mean, we saw in the Great Depression The economy didn't correct itself in the Great Recession as well. Even with expansionary fiscal policy, fiscal and monetary policy, the economy was very slow to grow again. Okay, so let's look at the case of a recession. So let's say aggregate demand shifts to the left. So we go from point A to point B. Okay, and again, output is below potential output. Okay, so there's an increase in unemployment. Downward pressure on prices, so we already went from price level 1 to price level 2. And so in the long run, workers will be willing to accept a lower wage and other input costs will fall. Okay, so this will shift aggregate supply to the right since now production is more profitable and the economy ends up at point C. Okay, back to potential output and full employment. Okay, so the model assumed that, okay, once we reach our new equilibrium, that prices stayed constant. In reality, when there's economic growth going on, there's always a small rate of inflation. Okay, and this is because ongoing economic growth is shifting aggregate supply to the right, and ongoing increases in money supply shift aggregate demand to the right as well. So, whenever there's more output produced, then the Fed also increases the money supply so that there may be enough dollars to buy the output out there. Okay. Luckily, the long run trend has been that our economy is growing and that there's been increased output for most years compared to previous years. And so what we see is we have a production possibility frontier here. And so we have, production of capital goods and consumer goods. And due to increases in labor and technology and productivity, okay, the production possibility frontier has shifted outward, so we're able to produce more of all goods than before. And so long run aggregate supply is constantly shifting. It's not the price level that affects long run aggregate supply, it's increases in production possibilities. So increases in technology, increases in productivity, increases in human capital, etc. Okay, so we can see here that the economy keeps growing in the long run, and so as aggregate demand and aggregate supply keep shifting rightward, we end up at a higher level of output and also a higher price level because there's been low but moderate amounts of inflation going on. Okay, so we were here in the past and we are here, for example, in the present. More output, higher price level. So a major goal of the Fed is to have low inflation rates and also low unemployment rates. However, what we've seen is that the Fed could influence this in the short run, but in the long run, that there's no significant trade-off between inflation and unemployment. Also, there's circumstances beyond the Fed's control, such as aggregate supply shocks, that cause both unemployment and inflation to increase. Okay, let's look at some examples. Okay, so back in the late 50s, early 60s, some economists saw that there was a trade-off between higher inflation rates and unemployment. The higher inflation was, the lower unemployment was. And data in the 60s showed that this was, in fact, a true trade-off. That, as each year in the 60s progressed, unemployment got lower and inflation was higher. As you can see here, when aggregate demand gets higher and higher, then output also increases. Increased output means less unemployment, And you can also see price level rises as well, which with each shift in aggregate demand. Okay, and if we were to look at actual data, we saw that unemployment was lower. Okay, as inflation was higher. Okay, so, economists took this as gold, though there were some skeptics. And they were like, great, okay, so if the Fed wants to decrease unemployment, all they have to do is set the inflation rate higher than expected. Okay, but some economists argue that this can be done only in the short run, but in the long run, okay, as we've seen, the price levels don't affect output and unemployment. Everything goes back to the potential output and full employment rate. But what also happened is in the 70s, there was the OPEC oil price shocks. OPEC reduced the world supply of oil. And so this caused aggregate supply to shift to the left and created a situation called stagflation. And this is stagnating output with inflation. And so this ended up shifting the Phillips curve upward. So it didn't show a trade-off between inflation and unemployment, because in this case, there was a positive relationship between inflation and unemployment. As inflation rose, unemployment rose as well. So what we see is that in the short run, under good economic conditions, there could be a temporary trade-off between inflation and unemployment, but in the long run, there's no trade-off, since inflation doesn't affect output, therefore doesn't affect unemployment either, and so the long run Phillips curve is vertical. Okay, so here we have a misery index, and this is the sum of a country's unemployment rate and inflation rates. And so the assumption here is that the higher the misery index is, or the higher the inflation and unemployment rates are, then the more miserable a country is. But that's not necessarily true, because Japan, is low on the misery index. However, they have failed to sustain positive economic growth in the last 2 decades. They've remained very stagnant, whereas Germany has sustained great economic growth, but they are much higher than Japan. You can see here US is in the middle. And so, most economists don't consider a change in inflation the same as a change in unemployment. Okay, so looking back here, the long run Phillips curve is vertical because in the long run, there is no trade-off between inflation and unemployment. So inflation can be 15% in the long run or 3%, but there's going to be no trade-off. Unemployment will stay at 5. Okay, so going to supply side economics, or what is known as Reaganomics. Okay, so during Reagan's term, he had an economic advisor, Art Laffer, and he had what is called the Laffer curve. Okay, and basically, the Laffer curve states that if you tax people beyond a certain point, so we can see here, down here is 0%, and then up here is 100% taxes, that after a certain point, they will lose interest in working. It's a disincentive. So, for example, if 75% of their salary is going to taxes, then they're not going to work as hard. And so you can increase tax revenue if tax rates are below M. You can increase tax revenue up to tax rate M. Okay. And this is where revenue is maximized. Okay. But once you increase the tax rate above that certain point, okay, then tax revenue is minimized because people will work less, and so there'll be less to tax. Okay. So this is one of the big reasons why Ronald Reagan greatly reduced taxes during his presidency. Okay, there's a lot of criticisms of the Laffer curve. First is that there hasn't really been a lot of strong evidence that higher taxes lead to less worker productivity and also less incentives to work. The other criticism is that when the economy is at full employment or even higher, then decreasing taxes shift aggregate demand to the right and increases inflation even more. And and this will probably prompt the Fed to engage in restrictive monetary policy to help control inflation. And then what ends up happening is real interest rates will rise, which will decrease investment. Okay, so it kind of cancels out the purpose of lowering taxes to begin with. And also the position on the curve, we assume a point M, but what exactly is point M? It's kind of hard to understand what that point is in the US. Now, economists do agree that the Reagan tax cuts did help the economy because it was just coming out of a severe recession from the 70s. And so tax revenues actually increased despite the lower tax rates because the economy expanded and so more people were working. The other thing is there's also an agreement among most U.S. economists that right now we are at a point below M on the Laffer curve. However, increase or decrease in taxes, it's hard to estimate just how much change there will be in tax revenue because there's many other variables at play. Okay, this concludes chapter 36.